Hello, this is Kanak Jain. Today we have with us a very special guest, Mr. Rakesh Tarway. He is a fund manager with Motilal Oswal Mutual Funds, and he manages portfolio management services, which is PMS. This is something which is very special, and we will be talking about portfolio management services today. Welcome, Rakesh.
Hi.
Today we would like to know something about what is PMS. When it comes to PMS or mutual fund is something which is still people know, but about PMS, would you tell us a little bit more in details about what PMS is and how it works?
PMS actually stands for Portfolio Management Services. In basic difference between PMS and mutual fund is that PMS can be customized to an individual's requirement. Suppose a person does not want to own a certain type of security, certain type of sectors, that can be excluded. It can be relating to a particular strategy. Suppose he wants to put money only in mid caps, or he wants to put money only in large caps, or he doesn't want to put money in a sector, or he wants to put money only in a sector. All these customizations are possible, but in PMS you have to put a minimum amount of money for being eligible. So that right now that amount is 25 lakh rupees, and SEBI has said that that amount will be revised upwards to 50 lakh rupees minimum. So in mutual funds there is no such requirement. You can start with 500 rupees also. So that is the basic difference between PMS and mutual fund offering.
So what we understand when it comes to PMS, minimum investment sum should be 25 lakhs, which is going to be 50 lakhs very soon. And now, is this something which is very personalized, specialized, or it is just like a normal mutual fund where buying and selling is happening? Yeah, there is a taxation difference, but how is some HNI thinks that it is a very HNI product? Is it like that?
HNI in the sense, there is a requirement of 25 or 50 lakh rupees, so that obviously is a difference. In a mutual fund you can start with a lower amount, much lower amount. In PMS you cannot do that, so that is definitely a difference over there. Apart from that, some bit of customization is obviously possible in PMS. Other thing is taxation. PMS is held in your demat account. It's a normal demat account which is opened in your name, and the securities are held in that demat account. So you know what stocks are owned by us. In mutual funds, you know just the NAV, means portfolio is published on a monthly basis in mutual funds. In PMS, you can know your portfolio the way it happens, the way a fund manager does it. It's in your demat. So those things, that transparency is a little bit higher. And obviously, means you can take a concentrated bet in there is no restriction in terms of, suppose I am putting a mid cap strategy. There is no restriction that I have to own a certain type of securities only, which is there in the mutual funds at this point in time. So that's a big difference in PMS setup.
It is also mentioned that when you are doing a PMS, you can see our portfolio every day. And not only that, in fact, each and every transactions and your holdings and everything is getting audited, and those audited statements are also shared with the investors, which they can actually share it with their accounts purpose and all. Is it like that?
Yeah, means it's in your demat, so everything is with you. Means you can share whatever you want. It's a demat account in individual's name, which is opened specifically for that purpose. But that account is in individual's name, so he knows all the transactions which has happened. He has the statements. He can share it with his CA for tax purposes. So those things are over there. There is a taxation difference because mutual funds, the tax is levied at the NAV level, means at the unit level. Here, whatever transactions are happening in the demat account, which is specified for PMS, so tax will be levied based on that. So whatever tax rules apply for an individual for buying and selling of securities, individual securities, those tax rules will apply for that PMS in basically in that demat account. So that is a basic difference. In mutual fund, it's at unit level. Whatever mutual fund does at their end in terms of trading in securities, that does not impact taxation. In PMS, that taxation impact is there. Suppose stock is sold within a year, so means that will be counted as a short-term gain, and a stock is sold after a year, that will be counted as a long-term gain. So that is a big difference in the taxation between PMS and mutual fund. In PMS, that is not the case. Suppose a mutual fund manager sells a stock within a year or whatever it does, it does not matter for the ultimate investor. His taxation is counted at the mutual fund unit level. If he is holding for a year, he will be eligible for a long term capital gains, and if he is holding that unit for less than a year, then he will be eligible for short term capital gain in mutual fund. So that is a basic difference between the taxation of two schemes.
Rakesh, please tell us about the history so far as Motilal Oswal PMS services is concerned. I think you are managing quite a big amount of PMS with clients all across India. So tell us something about that. What are the existing strategies, how their performance has been, and then what is new which is going to come?
Yeah, we are one of the largest PMS managers. Actually, will be the largest. We manage close to more than 15,000 crore of money in PMS schemes. We have around 30,000 clients in PMS. We have we run strategies ranging from large cap to mid cap to multi cap and small cap. Right now we are offering a mid cap strategy. It is a focused mid cap strategy where the most of the investments will be done in the stock number 101 to stock number 400. So the market cap range for the portfolio will be roughly 3,500 crore to 25,000 crore. So it is a mid cap basket where majority of the investments will be done. Apart from that, this product does not have a fixed fee structure. We shall not be charging any fees in this product. Any fixed fees. There is no setup fees, there is no custodian fees, there is nil means nil. There is no fees. Fees will be charged only after we get a 6% return for the investor. So suppose 100 rupees invested today, and investor has 106 rupees at the end of 1 year, there will be no fees charged. Suppose investor gets 110 rupees next year, so 100 rupee becomes 110 rupees. So the differential amount between 10 and 6, that is 4 rupees. Out of that 4 rupees, 20% will be charged as fees after 1 year. And a year after that, my starting point becomes 110 rupees. So that's how it works. There is no fixed fees. So it means investor will not shell out any fees if he is not making at least fixed income return. So 6% is thought about putting a fixed income number. Right now, any FD on a post-tax basis yields you roughly 6% on a year. So that is the thought process for putting that 6% number. Once you cross that 6% threshold on a compounding basis every year, then a 20% sharing will be charged by the AMC for the client. So that is the fixed fee. So it's a win-win for the client. Client does not pay any fees till the time he doesn't earn money. We also don't earn any money till the time we don't at least generate a fixed income return, because fixed income return is available for free. Means anybody can put money in an FD and it does not cost you any fees. So till the time we don't beat that thing, we are not going to be charging or earning any fees. Similarly for the client, if he gets 6%, it's free for him. So that's how this scheme has been designed. There are very few, means I don't come across any other large competitor who is offering this kind of thing in the, particularly in the mid cap, not in the mid cap, across any market cap category. There is not a large player who is offering this kind of scheme for the investors to put money to basically pay fees when he earns a at least his fixed income return. So that is the USP of the product. Apart from that, the USP is that it's a focused mid cap thing. There is no other PMS right now in our offering which is giving you access only to pure mid cap stocks. So these are the two USPs of the scheme.
So, like, if somebody is really looking, most of the time we think, there is a lot of fees which is charged, even if somebody is not making good money because the market is not doing well. So, I think this is one scheme, especially for some individuals who are looking for something which is very, very personalized, wherein they can actually invest their money and they will not be charged a single penny till the time they are actually getting a 6% fees, which 6% return, which is equal to the FD return. So this looks an amazing product, and I think this is for people who are especially looking for a special service which is like very personalized in form of a portfolio management, and this can be a very good avenue. Now, the next question, big question, which is why mid cap? We have seen in the last 1 year or 2 years rather, only and only large cap stocks have delivered good returns. We see that most of the time, what has happened is the stock market is up, but individual portfolios, especially with mid caps and small cap, has not delivered any return. So why are you thinking at this point of time, when in last 2 years large cap has only delivered return, and we actually want to focus on mid cap, or why we should focus on mid cap?
Markets work in a basically cycle. So if you look at, I'll give you some history. If you look at say 2017 end, starting from say 2014, so during that period, we saw a huge rally in the small cap and mid cap basket both. Indices themselves actually more than doubled in 3 years. Individual stocks multiplied depending on what is the kind of company, ranging from 3x to 10x in 3-4 years. If a company is good, it's doing well, means everything did well in during that 2014 to 2017 period. So at that time, at the end of 2017, nobody was we were getting a lot of money in the small cap, mid cap. A lot of money was raised. After that, what happened? In 2018 and 19, the tide completely turned. And now 2018-19 has been a complete runaway bull year for, runaway bull time for large cap stocks. Not even the full large cap basket. It's just only top 20, top 20, top 10, top 20 stocks. So that's how the market has been for last 2 years. Had somebody thought in 2017 that okay, mid caps have rallied like this, so one should be taking a counter cyclical view and actually withdrawing money from mid caps and putting money in large caps, you would have made a lot of money by now. Similarly, somebody thinking at this and at the same time, in the same token, had somebody done the reverse, which most of the people did actually, because most of the investors try to drive looking at the rear view mirror. So 2014, 15, 16, 17, they did well in the mid cap. So more money was poured in the mid cap, small cap basket, and which actually did not do well for next 2 years. So taking a counter cyclical approach in markets actually takes courage. But at the same time, it is counterintuitively, it is a least risky part, because prices have corrected, valuations have corrected. Your profit, if you are in a good company, profit is higher than what it was 2 years back. So your asset has become cheaper. So taking a counter cyclical view at times looks like courageous, but it's a more logical way. It's actually has less risk. So right now, after correction in mid caps, in the small cap index has corrected by more than 30%. Your mid cap index is still down around 20%. So I'm talking of index. Individual stocks are down more. So if you take a counter cyclical view at this point in time, that one should actually be deploying more money relatively in the smaller segment of the markets, basically mid cap, small caps. Chances are that he will make a higher return. As it happened, in the last cycle between 2017 and 19 for the large caps. You can go back, you can see the similar thing happening in 2006 also, 2009, 10 also. So it's that counter cyclical thing looks like at when it starts, it looks like very courageous, it looks like not the logical thing to do. But if you have a second order thinking, you will realize that actually my asset prices have become cheaper because of this. And in equity markets, the only way to make money is buy something which is available cheaper than its value and sell when it's available, when it's quoting higher than its value. So right now, if after so much of correction profits are higher, valuations are lower, probability of that asset is cheaper than its value is high. So one should take a bet at that point in time. That's what is called counter cyclical. It looks courageous, but that's I think on a second order thinking, it is a more logical thing to do in equity markets.
Yes, indeed. It needs a lot of courage to actually invest in time when something which is not following as per the trend. Yes, the valuations of mid cap and small cap is available at this point of time at a very, very good valuation, and it is a good time to invest into mid cap and small cap. But again, there is a tussle between greed and fear. So whenever it is like down, we become more and more fearful, and nobody can actually stop that. So at this point of time, yes, everything is down, and still we all are very, very fearful that whether we should be investing into mid cap and small cap. But again, as Rakesh, you mentioned rightly, we need a lot of courage to actually invest and actually gain out of it. And I think in next 2 to 3 years, things will be little better for mid caps and small cap, because this is an opportunity which is there. You have also created a portfolio, because this mid cap PMS which is there, people have already subscribed, people have started investing in. So can you just share some of the stocks and a little strategy why you are choosing such stocks, and in the coming next 1 year, 2 years, what is that you will be doing so that investors can actually generate a good return out of this particular strategy?
I would not like to go and put individual stocks name, but right now suffice it to say that we got money 2 months, actually 2-3 weeks back, and we have started putting money in the strategy starting 1st of January. We have already invested 45% of the funds which we have got, and by before budget we intend to invest 60% of the total money which we have got, and gradually we shall invest more by the end of this financial year. So as we have spoken, all the stocks which we have bought are in the range of market cap from 10 to 25,000 crore at this point in time. It is across sectors: financials, consumers, services, IT services. So all these sectors are represented in the portfolio. Total right now we have bought around 6 stocks in the portfolio, and it is across the sectors. It has representation from IT sector, it has representation from financial services, it has representation from general service, the services sector, and it has a representation from the consumer as well. So this is the broad thing, and market cap range right now is 10 to 25,000 crore for the portfolio.
The last question, what is the tenure which one should invest into a PMS like this? Do we have any exit load if somebody would like to come out, let's say within 3 months to 6 months, or what should be the tenure he should look into for investing, whether it should be 1 year, 3 years, 10 years, 20 years, whatever it is?
There is an exit load if somebody wants to exit within a year. There is an exit load. Tenure for this is, there is no defined tenure, but anecdotally speaking, this kind of thing where you want to put money in relatively smaller companies, but they are not so small, means in this kind of setup, for the potential to be fully realized, it takes around 3 to 5 years. So minimum is 3 years, and actually best is 5 years. If you have a 5-year horizon, you will realize the best potential of what that investment can do. 3 years, it's iffy, means it can be, it cannot, it may be, it may not be. But if somebody has 5-year horizon, and if somebody is putting money in a systematic counter cyclical manner, 5 years is a good time frame for the potential of the investment to get realized. So I still say right now one should put money with a 3 to 5 year view in the equity markets, and it will be better if he has a 5 year view.
Okay, so thank you very much, Rakesh. I think this was a really nice understanding on the mid cap strategies of this PMS, and investors who are actually looking for a 3 to 5 years growth story, which continues with the Indian growth story. I think it is suggested, and it is good to invest in a fund like this, wherein mid cap and small cap, which is again going to create a very good return with the Indian growth story. So thank you very much, Rakesh. Thank you for being with us, and thank you to all the Geo Business viewers. Thank you very much.
Thank you. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.